It is hard to get more recession-proof than a good railroad stock while making cash at the same time. Holy banana bread, let's do this! I love railroads, and anybody who has been following the channel should already know this. They are an essential part of our supply chain, which makes them not only recession-proof, but also a good choice when it comes to total returns. This at least has been the case in Canada. Both Canada and the United States have some of the best railroads in the world. The North American Rail Corridor is top-notch, and this is not only good for profits, but also provides that backbone that many of our industries and businesses rely on. Rail is simply the cheapest way to move stuff on land and maybe the best stocks to add some stability to your portfolio. Before we hitch that caboose, tell me in the comments if you currently hold any railroad stocks. I hold 3 of the 5 we are going to talk about here today. I am always grateful when you drop in on the home of free financial content on YouTube. While you are here, please subscribe as you don't want to miss a single moment, and a huge thank you for that click. There is a lot I could say about railroads, from their importance in our history to how they opened up the Western trade routes. In many cases, they united our nation and the American nation too. The history of North America Rail is absolutely fascinating, and I would absolutely recommend that you check some of that out for yourselves. In today's list, I have 5 of the biggest North American rail companies. That includes 2 from Canada and 3 from the United States. Our Canadian railroad companies have been owning the bear market. But how about the US? We are going to find out in just a moment. So, without any further ado, let's sound that conductor's horn and get this list on track. We will begin in the U.S., where we have America's 3rd largest railroad company. Norfolk Southern Corporation has a ticker of NSC on the NYSE. They started up back in 1990 and are currently based out of Atlanta, Georgia. They operate in 22 eastern states, and they also have some exposure to Canada via the Albany to Montreal Canadian Pacific route. They have a market cap of $58.09 billion and a beta of 1.32. Their earnings per share come in at 13.57 with very little dilution. They also have a price to earnings ratio of 18.40, which is lower than the industry average of 20.46. Debt-wise, they have a debt to equity ratio of 119.79, which is once again much higher than I like to see. Jumping into dividends, they have a dividend yield of 1.977%, which is paid out quarterly in the amount of $1.24 USD per share. Their payout ratio comes in at 35.45, which is not too bad. With growth, 2021 saw a share increase from $231.18 to $298.99 for a return of investment of 29.33%. And adding in dividends, once again, we get a total return of 31.31%. So far in 2022, we have seen their share fall to $250.91. This translates into an ROI of negative 16.08%. Once again, this is only slightly better than the S&P 500. Southern Norfolk has also been plagued by staffing shortages as well as union issues. They do have a big hurdle ahead of them if they want to get back on track. Sticking to America, with their 2nd largest railroad company, CSX Transportation has a ticker of CSX on the NYSE. They were founded not too long ago in 1986 and are currently based out of Jacksonville, Florida. They do operate on the East Coast, and in addition to the US, they are in both Ontario and Quebec. They have a market cap of $67.15 billion and a beta of 1.24. Their earnings per share come in at 1.88 with very little dilution. They have a price to earnings ratio of 16.99, which is lower than the industry average of 20.46. Debt-wise, they have a debt to equity ratio of 140.11, which is a concern for me. As you guys know how much I dislike a really high debt load. Unfortunately, I do suspect this may be a reoccurring theme with the American railroads. Jumping into dividends, they have a dividend yield of 1.252%, which is paid out quarterly in the amount of 10 cents USD per share. Their payout ratio comes in at 20.90, which is not too bad. In regard to growth, in 2021, we saw a share increase from $29.13 to $37.82 for a return of investment of 29.83% and a total return, once we add in those dividends, of 31.08%. So far in 2022, we have their share falling to $31.94 at the time of recording. This translates into an ROI of negative 15.55%. This is only only slightly better than the S&P 500 and their current negative 16.22% return. CSX has been hit hard by worker shortages and have not been able to fully meet the freight demand as a result. And this has been hurting their bottom line. Once they resolve their labor issues and start shipping more, things should improve. I would also love to see them work on reducing their debt a wee bit. We are going to shift to Canada with Canada's second largest railroad company. Canadian Pacific Railroad has a ticker of CP on either the TSX or the NYSE. They were founded way back in 1881 and are currently based out of Calgary, Alberta. They are the only railroad company in North America with rail access to Canada, the United States, and also Mexico. That is, of course, once the deal to acquire Kansas City Southern completes. They have a market cap of $94.71 billion and a very stable beta of 0.81. Their earnings per share come in at 3.13 with no dilution. They have a price to earnings ratio of 32.53, which is higher than the industry average. However, that is kind of expected after winning the Kansas Southern bid. Debt-wise, they have a debt-to-equity ratio of 55.15, which is not bad at all. And jumping into dividends, they have a dividend yield of 0.746%, which is paid out quarterly in the amount of 19 cents Canadian per share. Their payout ratio comes in at 24.28%, which is not bad. With growth, 2021 saw a share increase from $87.10 to $94.21 for a return of investment of 8.16% and a total return of 9.35%. So far in 2022, we have their share continuing to rise to 101.82 at the time of recording. This translates into an ROI of 8.08%. This really does demonstrate that recession-proof aspect of railroads. Well, at least in Canada. I do expect CP to grow a lot in the next 5 years. Once the deal with Kansas City Southern completes, they will have so much potential to threaten the top spots on this list. We are going to stay in Canada with Canada's largest railroad company and by market cap, the second largest railroad company in the world. Canadian National Railway has a ticker of CNR on the TSX or CNI on the NYSE. They were founded way back in 1919 and are currently based out of Montreal, Quebec. They have tracks from the Atlantic to the Pacific to the Gulf of Mexico. They also have tracks going all the way up into Canada's north, and as such, this makes them an essential part of our resource sector. They have a market cap of $109.68 billion and a very stable beta of 0.71. Their earnings per share come in at 7.28 with very little dilution. They have a price to earnings ratio of 22.25, which is slightly higher than the industry average, but not by much. Debt-wise, they have a debt-to-equity ratio of 71.59, which is also not too shabby. Jumping into dividends, they have a dividend yield of 1.809%, which is paid out quarterly in the amount of 73.3 cents Canadian per share. Their payout ratio comes in at 37.02%, making their dividend very sustainable. With growth, 2021 saw a share increase from $138.69 to $158 for a return on investment of 13.92% and a total return of 15.73%. So far in 2022, we have their share continuing to rise to 161.97 at the time of recording. This, of course, translates into an ROI of 2.51%. So far, Canada's railroads are absolutely schooling America on recession-proof. CN will, of course, continue to do well into the recession, and with more emphasis being placed on Canada's critical minerals, it will only benefit CN in the future. We are going to switch back to America with their largest railroad company, and by market cap, this is also the largest railroad company in the world. Union Pacific has a ticker of UNP on the NYSE. They were founded way back in 1862 and are currently based out of Omaha, Nebraska. They service 23 western states with about 8,300 locomotives. You guys know I am into CNR and CP. This is my third railroad stock. They have a market cap of $133.72 billion and a beta of 1.12. Their earnings per share come in at 11.20 with very little dilution. They have a price to earnings ratio of 19.42, which is of course lower than the industry average. Debt-wise, they have a debt to equity ratio of 298.48. Holy banana bread, that kind of hurts hurts my soul a little. Jumping into dividends. They have a dividend yield of 2.391%, which is paid out quarterly in the amount of $1.30 USD per share. Their payout ratio comes in at 44.29%, which is good. With growth, 2021 saw a share increase from $201.37 to $253.33 for a return of investment of 25.80%. Add in those dividends and we get a total return of 28.19%. So far in 2022, we have seen their share price fall to $217.50 at the time of recording. This translates into an ROI of negative 14.14%. Once again, still better than the S&P 500, but it is a wee bit concerning. I have no doubt that Union Pacific will more than likely thrive once again in the future. However, in the present, they have been facing the same issues as the other American railroads with worker shortages and union issues. Their role in the supply chain does, however, offer them some protection. Canada has absolutely shown how a well-managed railroad can be that recession-proof investment we are looking for. Both CNR and CP have done it right. Lower debts, share prices growing, and some good growth. I absolutely love these stocks. America has struggled a lot more, and despite all their issues and debt levels that I really don't like, they are still outperforming the S&P 500 a wee bit. Though, honestly, I kind of expect more from them. I want to see them moving beyond the strikes and worker shortages and start being that supply chain backbone that is too important to fail. As Canadians, our two railroads are truly a couple of shining beacons for the whole industry to take notice. I am not just talking about North America. They are great examples for the entire world. The fun does not have to end here. Check out my video on Canoe's cash redemption that I will link on the left. Otherwise, check out the video on the right that YouTube thinks you will like. Your click will decide who is right, and I will see you in the next video.